everybody, and welcome to the Dash Trader Newsroom. The long-awaited market correction has come, or is worst yet to come. My name is Michael DeJoyer. I'm Director of Educational Services here at Dash Trader, and joined by my co-host, Jill Molandrino, Global Markets Reporter with Nasdaq. Hey, Jill, how are you?
Good.
All right, so we finally got the correction that you and I have been talking about. I mean, we kind of were spot on 2 weeks ago when we had talked about this. Just to remind everybody, a market correction is 10% off the market highs, while a bear market would be 20% or more from the market highs. Could it be the proposed tariffs? Is it the other drastic changes in policy that's bringing on the bear market? Could it be a cutback in government spending, or all of them combined? What are your thoughts as to the catalyst? Could it be profit taking? I mean, certainly it could be all of these things.
Yeah, Mike, it's so crazy. Let's put this into perspective. So my last day, and yours was probably the same too, with COVID, was Friday the 13th, March 13th, 2020. So
Yes,
we're almost 5 years out from that, and think about how much the market has had to digest in 5 years. That could have been a lifetime, at some other point in market history. So when you look, you take a step back and you look at it that way, and the returns that the market has made in just 5 years, longer term, and when people like you and I are retired, and the next generation of traders and investors are in, they will look at this, from a more long-term perspective. So for a pullback to take place, to see some vol in the market, you're supposed to see volatility in the market. I think what the market is contending with, I don't know if it's necessarily the uncertainty of the tariffs and policy, because we know at one point we're going to have a resolution. There will be a new strategy. There will be a regime. I think what the market is trying to digest is the velocity at which this is taking place, and other journalists and content that I listen to and read and so forth. The concern that I'm seeing is they're aggregating what they're hearing from analysts is it's the back end. So we know cuts are being made. We know what the wants and desires are of the administration, but how do you get from A to C if we don't know what B looks like? So we know we're going to get there. And if you're a longer term investor, such as myself, I mean, for you as a trader, this is like a gift, right?
Yeah, definitely.
I'm thinking about, once we get to the new tariff regime, what is going to benefit from there? As an example, small caps, if their domestic production and manufacturing is in the US and they don't have to deal with the expense and the time that's required to move their operations over, and if interest rates end up coming down, that could potentially be a catalyst for them. And small caps haven't gotten off the finish line in who knows how long, but they could potentially benefit if they're smaller, they're nimble, and they're already onshore. So I'm kind of thinking in that respect. I think the financials might potentially catch a bid, but again, it's not necessarily the end goal that's concerning. It's the chaos in between, which I think has the market and the economy confused. And we also have to remember that the market and the economy are two different things. So the market's kind of always in a rush, if you will, and whether
that's what we
but
say.
the whole thing is whether you agree with the Trump administration, what their end goal is. I don't think that's really necessarily the concern. It's the execution, and it's the in-between that I think is going to be impactful. And no, you're not going to make everyone happy all the time. And it doesn't matter if it's Biden, if it's Trump. These things do not correct itself. It's not like buying the dip when you make these policy changes. And I think we just have to exercise some patience and give someone the benefit of the doubt. It's just that, like, the chaos in between that's confusing.
Absolutely. I would totally agree. And I wanted to point out that, yes, from the trader's perspective, not only do we like volatility, but we like predictable price volatility, meaning that when we saw the initial reaction to the tariffs, when Trump first initially mentioned that he was going to potentially be giving tariffs to Canada and Mexico, the market sold off. Then he put a stopgap of 1 month down the road. And then literally to the day, 1 month down the road, the market sold off again once those new set of, the next deadline for tariffs came in. So the reason we like to trade earnings is you're given an earnings date. You have volatility and you have a predictable date to expect that volatility. So from a trader's perspective, this has been fairly expectable, right? Like you expect the reaction to the market every time. And then now, yet again, we've had new tariffs, but some of those tariffs have been delayed for another month as Trump continues this kind of negotiating tactic. So let's jump into what is the news catalyst. Is it the tariffs, with Mexico and the reciprocal tariffs with Europe? What will the impact of those tariffs be? I mean, it seems like, like I just mentioned, that this is a negotiating tactic of sorts. Or is there something more? Is there going to be a sharp pickup in layoffs? I mean, we saw this jobs number, which I do think was a contributing factor this time around. It was a significant increase in jobs number. We're going to take a look at that in a little bit more detail in the next slide. So what are your thoughts? I mean, of the actual impact with this kind of ongoing, tough talk with Canada, Mexico, and potentially the EU?
Well, we went through this in Trump 1.0 when the rhetoric really heated up in December 2018, and his tactic somewhat is similar to what we're seeing now, where there's not that there's backtracking, but there's revisions, which is part of the deal making. I think what's again confusing is how the motivation with fentanyl and trying to, whatever the situation is with Canada and Mexico, how do you bench that? Is it, do autopsies show less death? They're not what's the right word? Not procuring. They're not finding, as many packages of fentanyl or the components of that at the border as expected. And I think where the confusion is, with the next date being April 2nd, and that's when the real tariffs are, going to come to play. I'm just confused as why fentanyl is at the, never mind the human perspective, but at the forefront of it. And how do you measure that? How do you bench that? Because the whole thing is, if you have lower numbers, isn't that a good thing, right?
Yeah.
If you have higher numbers, either we're catching more or we're not doing a good job.
As an analyst, you're looking at, okay, so this is what we're trying to reduce is fentanyl, but how are we going to measure this, and how are we going to quantify that we're having an impact?
Right.
Whereas some of the other things are kind of straightforward. You want to increase revenue by hiring tariffs, but the item that they're being attached to it's a little opaque as to how we would measure success considering that benchmark. And before we jump to layoffs, what are your thoughts with that entire interaction with Ukraine, the war in Ukraine? Do you think that was is that impacting the market at all? Do you think that that's just throwing in added uncertainty with the Oval Office conversation between Trump and Zelensky and JD Vance? Is that playing into this at all?
I don't, from a political perspective, I can't comment on that because I just don't have the background for it. I think part of it is, and I can understand, as an American, the frustration of money going everywhere. We're putting the most money into NATO out of, all the countries, and we're the one that is really supplying, the man and woman power and the machines and everything to get this done. And there's no end goal. What's the strategy to getting this over with? So if we pull resources, it's going to end one way or the other. So I understand it from that perspective as an American. When it comes to politics, I can't quite figure it out. I think a scenario, like we witnessed, I think it just adds more to, the chaotic nervousness that the market might have because we don't know what the strategy is.
Yeah, it's a general sense of uncertainty, which is a little off-putting in general. And I chalk it all up to political theater. That's the two. I mean, I think it was a certain degree of political theater, but at the end of the day, it does add to the overall uncertainty in the market. Now, you brought up a good point. That it's kind of the willy-nilly spending everywhere. Let's just say that they cut I don't know, $750 billion from the US budget that was just going to wasteful spending.
Mhm.
And now you have a 250% increase in layoffs due to 62,242 government jobs alone that were kind of cut in the past month. Um, all that money coming out of the economy. Okay. From a short term, you can understand why the market would correct with all that money, all of those people now not spending money because they're concerned about their future of their job. But could potentially this be a good thing from the economy's perspective, longer term as an investor? Like, I'm looking at it from the trader's hat, which is okay, I have predictable price action, which can trigger a sell off on specific dates that are being told to me in the future. And then at the same time, I'm saying, okay, well, having all this unnecessary, pork barrel spending cut out of the budget, although it might have some pain in the short term, from an economic standpoint, this could potentially be good for the United States. And, we have a little image of a balanced budget. Not that that is anywhere in the cards at this point, but at least there is some lip service to it. Is it potentially that this could be a positive for the U.S. economy as it is a necessary belt tightening?
So there's a couple things to unpack here. Whether the federal government is cutting employees or cutting funding to certain programs and so forth, it's one thing. It's almost like a one-time charge, right?
Yeah.
So what does that spending scenario look like going forward, right? So,
Mhm.
just because as an example, you pay off your credit card, but what if you go and open up another MasterCard, right? So it's kind of,
Excellent,
just
excellent point, by the way. I like that one-time charge from a public administration standpoint. That's exactly what it is.
right, but if there's no um strategy or no plan in place to fix the spending going forward, anyway, to our point, it's a one-time charge. I think when you see such massive layoffs occur, it does feel it does feel, the remaining staff, they feel uneasy, they might feel uncertainty, and that's why you could see some hesitation in spending. Anecdotally, my Mike, his friend was in Vegas, and he said it was quiet like COVID, which signals to me that people are hesitant when it comes to discretionary spend and
Yeah.
travel. I think, another thing, and just like we saw with the backlash with DEI, since
Yep.
it's such a 180 with the government, there has to be concerns, among employees that if the government, is cutting this much, does it make it less ugly for companies to do so? So I think you're going to see hesitation. And the numbers that came out this morning, and Rick Santelli made a fantastic point on CNBC, even though the disparity in what was expected versus what came in terms of production and spend, at some point, once this is over with and once there's clarity and a strategy in place with the tariffs, that demand is going to come back. So at
Yes.
some point, so when you look at your comps year over year, when we look at, the numbers next year at this time, you might see that disparity there. So there are silver linings, like I mentioned before, let's look at small caps as an example where other operations are onshore if this is the trend that's going, right? So you have that in mind, but it is anecdotally, we're starting to see, and now the numbers are supporting that discretionary spending and travel. And even in my own home, we were talking about it earlier today, extending a work trip that I had, and making it somewhat of a vacation. And I'm just like, let's kind of see what's
Let's
happening
see
here
how
and how
things
that
go. Yeah.
this is going to impact us, traveling and what happens with the dollar and all that. So
Yeah.
we're thinking about it.
Very, very good way to think about it, Jill. I appreciate all the insights as always, and I'll see you in 2 weeks.
All right, sounds good, guys. Take care. Good to
Bye
see
bye,
you.
Jill. All right, let's jump to the charts. We have the Nasdaq right now is trading near the low of the day, right near the lows of the day here at 4. This is the QQQ, which represents the Nasdaq 100. 487. We had a gap down, a little bit of a gap fade, and now we're kind of bouncing here at the lows. We did take out the low of that's Tuesday, so we did take out Tuesday's low. We gave back all of the rebound gains from Wednesday, and the market continues to trend lower. Let's take a look at the daily once again. the big level of support here on the Nasdaq. I'm just going to put this in with a horizontal line. The big level down here on the Nasdaq is this level here, which is basically 485, which is about 10%. This is the market correction level. It's a little bit more than 10% from 40. Yep, down. It's 10, 12% level on the QQQ. But that is the bounce or break point on the markets. Let's take a look at the but you could see from the M-shaped top, this would be the top of the M and the other top of the M, and then we've come back down to complete the M-shaped top pattern. I'm just going to put this in just so you can see it. That I would say that this is our M-shaped top. We did take out the midpoint of the M. Okay, so that's the M-shaped top on the QQQ. Let's do the SPY. So SPY looks similar. Also took out, this is a little bit more of a small N pattern, like the cursive letter N. I think we did a lesson about that at one point or another not too long ago. And then here it is. It comes back down and to this key level of support here on the SPY, which is 570, which would be the bounce or break point on the SPY. And on the DIA, very clearly defined double top, right? And this is a very clear N-shaped top. You can see the curl, the drop, the V pivot, the sloppy bull pennant that fails and then breaks down lower. Looks like we're rebounding, and we're a little bit better on the DIA than on the QQQ. But let's take a look at some of the tech stocks because I like to go through the Magnificent Seven, NVDA. NVIDIA totally in a sideways trend, not in an uptrend. So we have NVIDIA sideways trend. So I'm just going through the main stocks here. So let's go through Apple, AAPL. Apple sideways trend below its moving averages, but not selling off handily, holding up pretty well. MSFT. Microsoft definitely in a sideways to possibly downtrend. I mean, Microsoft is at the bottom of the range, really started selling off the middle of last year. Netflix, NFLX, big time sell off in Netflix. I mean, I would say that Netflix is in the process of reversing and fading the gap from its excellent earnings gap and run up. So this is more of a gap fill play on Netflix, but it was one of the stocks that was holding up the market, but now it has faded and filled that gap. This is a classic gap fade from a trader's perspective. We got NFLX. We have NVIDIA. We have Tesla. Tesla really getting hammered. From it really not performing very well. I think it's down from a 490 high to a 270. That is way out underperforming the markets. It is way weaker than the markets, and it has been in a downtrend for some time. And I believe that's it. But I mean, if we go to some of the other ones like AMD rather, AMD is in a downtrend. INTC, Intel, downtrend to sideways trend. PLTR, which was another recent darling, gap fading and filling. So, in going through the charts from a market breadth perspective, we are seeing weakness across the board. Even if you go to something like ExxonMobil, sideways to downtrend. Let's just look at X, U.S. Steel, sideways to downtrend. Visa card was holding up pretty well, but has now turned into possible downtrend territory below its moving averages. But again, you can see that the from stocks that were clearly in MRVL, this was a big loser today. Big gap down on Marvel Technologies, MRVL. Needless to say, you can see that the charts seem to be broken. Now, at the same time, GLD, gold is at its all-time highs. USO, oil is holding, but near the bottom of its range. You can look at USL, give a little bit of a longer-term perspective. USL, the oil contract. Oil is not the factor here, but certainly you can see the strength in gold and SLV and GBTC. There was a little pop in cryptocurrencies for a minute on the announcing of a cryptocurrency reserve, but then that subsided and gave back whatever gains that were short-lived. That was on Saturday into Sunday, or Sunday into Monday rather, but that was on the cryptocurrency, U.S. cryptocurrency reserve in the United States. So on that note, I'm going to wrap things up and say that caution is the rule of the day. So stay up to date with all things DAS by signing up to our monthly newsletter and email. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel at Dash Trader TV if you haven't already done so. And sign up for our newsroom reminders. Follow me and DAS on LinkedIn, Twitter, Facebook, and Instagram. Trade well, everybody, and I'll see you in 2 weeks.